So we're in the home stretch, so everybody wake up. How many people actually do their own books? Raise your hand. How many people delegate it to the bookkeeper? How many people actually produce a capital plan? That's what we're going to talk about. I have two objectives today, and one is to get all the passion that you have in creating this vision that Paul talked about, and the work that you put into developing the product and the recipes and the operational plan. I see this all the time, and then it stops when you get to the financial part of your business. It's intimidating. I talk to a lot of entrepreneurs. It's emotional, the debt, your friends and family. So what I'm suggesting to you is it will be easier and make more sense if you bring those same values that you rely on to start your business and pull those all the way through to how you decide to raise money. Why do you need equity? I just need a couple suggestions. Why do we need equity in a business? Sir, there.
Fund growth.
Fund growth. Give me another idea. What's another role that equity can play on your balance sheet? Stability. So I came up with some reasons too, if I can figure this out. There it is. So one of the roles that equity can play is you need some way to sort of reflect the value that you're contributing in your business. You might be 10 years in this business, and you need some way to capture that. There can be some mistakes. We're looking at a business now that has more debt than it does sales. They have 8 people working in a business. If they sold that business today and they go to work every day, it's a tough business, they actually collect food waste for composting, it would have a negative value, at least based on traditional ways to value it. One of the issues is they don't have enough equity in that business. So you want to make sure you have equity just so that you have terminal value or something at the end of the point when you're ready to sell the business that is not overloaded with debt, so you're not just working to pay off the debtors. So it can reflect value of your work over time. Someone mentioned growth. Depending on that vision that Paul talked about, you might decide that you want to sell out to Kellogg. If you decide to have a branded strategy, we get people coming in all the time. I want to build a brand. Brands cost money. Brands mean losing money for years as you create distribution and sales. Sales is number one because you're trying to get recognition. You need equity to fund those losses. Banks normally require 2 to 3 quarters of positive profits. You won't have that if you're going on an aggressive brand strategy. So you're going to need equity. So that's one of the reasons. You also might need equity because you launch your business. We're at the top of the economic cycle. What if we have another '08? And you've been working at this for 4 or 5 years? Do you want to only rely on servicing debt to get through a couple tough years? So equity can be that cushion to get you through uncertain events. A supplier disappears, an employee leaves and competes with you. It gives you a safety cushion, which every business needs. Governance. People don't think about this, but you start your business and you have the banker, and you have your mother-in-law, and you have your kid. Governance can be aligned with equity interests. So if you own 70% of the business, let's say that that's the case, and you sell 30% to others, it's clear typically who's going to make the final call. If you have mostly debt or you have a lot of fractional interest, that conversation can be very much more complicated. So you can use equity to make clear the governance structure of your business. I also jotted down a couple other items which someone talked about retention of employees. One of the ways that you can retain employees is to give them a stake in the business. If you're a social enterprise and you care about rebuilding Detroit and fair living wages and continuity and health benefits, you can use equity to do that. Give them a share of the business. It can be a shadow share if you want, just to reflect the success that you're building together. But equity can be used to get them to stick around much longer than just a paycheck, and also to buy into your longer term vision. There are multiple ways that you can do that. Employee stock option programs. We actually invest in businesses that over time plan to convert to that. So you don't have to do that initially, but it can be part of your long-range plan. Co-ops, and then certainly stock appreciation rights, which quickly are just, rather than giving someone equity, you would give them the difference of the value that when they started working with you to the time that they left. So they would get the value they helped you create. So those are some roles that equity can play. Does this make sense? Yeah. So who provides equity? This goes back to those values. Depending on what you're about, you have access to different types of investors. So we invested in a food accelerator in Boston. 70% of those entrepreneurs are women, people of color, and immigrants. There are pools of capital that are gender lens oriented, refugee oriented, economic development oriented, healthy food oriented, a range of different stakeholders who invest in entrepreneurs who reflect those values. So I urge you to go back and remember why you started your business and unearth some of those values and think about what constituencies might be interested in helping you do that. One of the ways that you do that is think about return beyond financial. Returns can be decomposed into social and financial. So if I'm creating jobs, if I'm hiring a difficult to hire population, if I'm sourcing locally, if I'm paying benefits, if I'm hiring mostly refugees, undocumented workers, etc., those are social returns that some investors will pay for. Will give you a lower interest rate or a lower equity return because you're performing these other social metrics. So I would think about that. These are the typical parties that you would raise money from. Friends and family. I think some of us are fortunate to have friends and family. I've started a business. I've relied on friends and family. In Boston, one of the reasons why Boston Impact exists is the average net worth of a black family is $8, and a white family is $240,000. That's one of the largest net worth disparities in the country, but this is happening nationally. So one of the things that we do is we step in as a friends and family money for those entrepreneurs who don't have that. So there's certainly funds like ours that are replacements for friends and family, but that's a natural first step. Angel investor groups. There are 40 angel groups in Boston. There are a lot of angel groups here in Michigan. They all have different preferences. It's important to look and research those. There's a group called Investor Circle SVN, which is a national organization. There's chapters here. Check out that group. There are big conferences in New York this week. I'm going to be there. But angel groups are important. One of the things you should think about is what are the return profiles? Are they looking for 10 times their money? Is it social returns? Investigate that. Venture funds. Venture funds are friend and foe. If you have a model that you're trying to scale up and sell to Kellogg in 5 years, and it's got a new technological bent, we had some examples here from some of the panelists about using artificial intelligence, etc. You design your business from the beginning, and you would take capital from providers who have those same expectations. Venture funds are a lot of those businesses don't succeed, so they require very high return thresholds from the ones that do. So if you take venture money, be ready for the ride that you're on, because it is a ride. But there's some business models that are appropriate for that. Private equity funds usually step in second stage or beyond. We've invested in a food company, it's a health bar that provides living wages, has diversity at the board, within management, but they're in the neighborhood, but they also have a board that is very experienced at brand building. They will be a national food brand within the next 3 years. They already have a big company sniffing after them. They took in private equity money, in part because their exit is that route. So it makes sense. Very high threshold in terms of returns. They also have an impact investor like Boston Impact. Impact investing is not new. The term is probably more prevalent now, but I talked earlier about understanding who you are and what your mission is. There's a conference in Colorado this week that I'm also talking at, which are 1,000 different investors. These are private individuals, portfolio managers, banks, community development, financial institutions, all looking for impact. And the market has become much more sophisticated where they're looking for curated impact. For example, I want a Michigan company that sources 50% of their product locally. Someone was talking about sourcing potatoes, primarily locally. You can tie jobs to that. Maybe there are folks working in your plant that are returning citizens. There are people who will pay you for that, meaning giving you equity capital for lower returns, lower than 10 times. So I would suggest that you look at those. And then public equity, which is ultimately an exit for firms that are trying to go large. Different ways to gather equity. Common stock, I think most of us are familiar with that. So you're at the bottom of the totem pole in terms of risk, but you have the most upside, and there are a pool of investors that are interested in that. Preferred stock, and this is actually really relevant for those who are using a cooperative form of structure, where you want to make sure that you retain control, but you also need that cushion that we talked about earlier at this presentation. You need to not be required to make debt payments every month, assuming you're in a growth mode. So you might use preferred stock, where you promise a dividend, et cetera. The dividends can be a variety of structures. It could be cumulative, meaning over time you add up the dividends and you're required to pay them at some point in the future. Or it could be variable. We're looking at a structure now where if the company has extra cash, they pay out a dividend. If they don't, they don't. And so this liability doesn't build up on the balance sheet, but there are ways you can structure that. All of these structures invite different types of investors into your business. Warrants and options are just two mechanisms. I'm not going to go into a lot of detail, but I want you to know about them because these are ways that you can offer stock in the future to certain investors who would pay you today, only because you're willing to lock in a price. So let's say that I know 3 years from now I'm going to issue more stock and I don't want to dilute myself today. I could sell warrants. I could give someone who's willing to loan money to me some warrants to buy stock in the future, and that's a way to add equity to your balance sheet. Structures to sell. And how am I on time?
About 5 minutes, 5 seconds.
Good. Structures to sell equity. Liquidity preferences. These are all terms you will hear. That's a promise that you will pay if there's a transaction or a sale of the company at a minimum. We often provide equity to entrepreneurs with a 2 times liquidation preference. That's the top line here, which is if the company is sold, that we would at least be paid twice the money that we invested before anybody else was paid. Direct public offerings are a new vehicle that you can go out and sell stock to local investors, and is a way a number of food companies that we've invested in have actually started. We've invested in a brewery that use a DPO, and essentially it's selling to the community, the same community that might be patronizing your product. Self-liquidating equity. Fair Food Fund, and I sit on that investment committee as well, and Boston Impact together invested in a catering company, which I'm going to talk about in a moment, where we gave them debt, but we wanted to make sure they had equity in the balance sheet so they could keep growing and raise money from the banks down the road. So part of that debt actually turns into equity, and then we will be paid back our equity through free cash flow over time. So it's a novel way to pay us out without having to sell your company, and you buy your equity back. The other items are typical. The one thing I wanted to highlight is convertible debt is quasi-equity. It's debt that can be converted, as I just described, into equity, again, giving you more latitude to manage your cash flow. These are the stages of equity. I think most of the companies here are probably seed round and Series A. You can see that the type of investors, and some of these overlap, given the stage, but I would argue to you that impact investors would be interested at most all of the stages. It just depends on how you match up with their interests. Here are a couple of examples. This is not a food company, but it's an example of a structure they can use. This was a company that actually does small batch laundry processing. The reason why I highlight it is we provided equity and debt. This was a company that actually looked at their value, so they were able to raise $400,000 of equity predicated on their commitment to hire returning citizens, offer profit sharing, deliver the laundry on bicycles, recycle 90% of the water that they use in the laundry. All of those things rang true to us and other investors. They ended up raising $2.5 million because of impact and being able to measure that. Fresh Food Generation is a deal that both Boston Impact Initiative and Fair Food Fund, we split this deal. So this is half the capital that we provided them. And it was a startup. They had zero money. They won $5,000 of a grant from Fair Food Fund. These are two young entrepreneurs who got together and decided there must be a way to have a catering company in Boston that had ethnic foods that served people in the community and cared about health. And so they started this. We loaned them cars. We gave them grants. They had nothing. Today they have more than $500,000 of sales. They're on their way to $1 million. And they needed growth capital. And again, they had no equity. So we decided to come up with a vehicle, and in this case, we used this self-liquidating equity concept to provide them equity. So it went out as debt, and that a part of it will turn into equity at some point, which will allow them to borrow from other people. They'll be bankable then. And then we'll get paid out of our equity at 2 times based on free cash flow. Now, we're still at risk, but it's a way to support the entrepreneur in order for them to have equity to distribute to their employees for retention. They source locally. They may actually want to do a merger with another entity. They'll have equity in the business to do so. Finally, equity is not the only player. I think we all know debt, and there are good purposes for debt. You want to use debt when you have short cycle investments, like accounts receivable, trying to finance that. You use equity for long-term things like the steel plant for the Way company that presented earlier, something that's going to help produce returns over a long period of time. You use equity. Short cycle things like accounts receivable, you use debt. You also want growth capital, but you don't want to give up control. So you certainly would want to use debt. Also, equity dividends are not tax deductible. Interest is. So you want to remember that and use that when it's efficient. And then finally, the world has gotten much more curated in terms of types of debt. We also offer debt, but that's the next topic. But there are so many derivations. There's royalty financing, which is quasi-equity, but really debt, which is a percentage of your sales ends up going to pay back the loan. There are many different institutions now, loan funds, community development financial institutions, SBA loans. They all have different requirements. We don't look at tax returns. We don't even look at your credit scores. And we've been very successful. There's some organizations that have a lot more documentation because they pulled down money from the Treasury. So you want to think about that, but the message here is take the passion and the vision that you started your business with, develop the operational plans, and then develop a capital plan and think about who are the natural stakeholders that want to see your business grow. And be intentional about that and revisit that every year so that you have a roster of financing options that you can tap when the time is there. And I will stop there.